Good morning, dear learners. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you all to the next lecture of my course on financial literacy. This is week 4, module number 4, in which we were discussing about the introduction to the loan facilities offered by bank, and lecture number 19, overdraft facilities offered by bank. In the previous lectures of this module, we had discussed about the different types of loans that are offered by the bank to their consumer, in which we had discussed there are secured loans, unsecured loans. On the basis of term, there are short term, medium term and long term loan, as well as there are some other categories of loans such as personal loan, in which we take educational loan, house building loan, then consumer durable loans. So, all these different categories of loans may be for the purpose of fulfilling the household need as well as the business needs of any consumer. In case of the overdraft facilities that are offered by the bank, these are basically customized loan facilities that are given only to the corporate owners or businessmen or entrepreneurs. So, in this lecture, we will be going to discuss about the meaning of bank overdraft and its key features and the role of overdraft in the personal finance and business financial management. We will be also going to understand how a consumer can prevent the bank overdraft in their current bank account, and we will be also going to learn the concept of cash credit as well as mortgage and reverse mortgage. So, let us continue with the content of this lecture. So, bank overdraft has been also covered in the previous lecture. The very basic meaning have been discussed in the previous lecture under the various types of loan that are offered by the bank. Here we are going to have a detailed analysis of this particular concept as well as the various characteristics related with the bank overdraft. Basically, it is a kind of credit facility that is provided to the current account holders of the bank for the purpose of allowing them to withdraw more money than it is available in their account up to a predetermined pre-approved limit only. So, this kind of bank finance is basically for the purpose of managing the day-to-day financial needs of any of the business organization. If the business owner or the entrepreneur is in need of short-term finances and if they want to have an immediate sources of fund, they can take the facility of overdraft from the banking institution. This service basically helps individuals and businesses to manage their short-term liquidity needs, and it usually involves certain kind of interest and fee that needs to be paid by the consumer for the purpose of borrowing such kind of loan. For example, if you have 1000 rupees in your account and your bank offers you an overdraft facility of 5000, in such case you can in total withdraw rupees 6000 at a point of time, and the facility is known as the overdraft facility. Now let us understand what are the various key features of the overdraft facility and how it is different from the other short-term loan. So, basically in this particular kind of facility provided by the bank, your current account must be linked to this particular credit facility. That means overdraft facilities given by the banks are basically linked to the current account or sometimes to certain saving accounts of the consumers also. So, basically it acts as a revolving credit. That means you can withdraw, you can repay, and you can then again in the times of need withdraw again from the bank as long as you are withdrawing your money within the pre-approved limit by the bank. So, that simply means if you do not have a current account or a saving account in a bank, you cannot take the facility of overdraft. Next is, it has a pre-approved limit. That simply means that according to the credit score, credit history, as well as credit worthiness of the consumer, a certain predetermined pre-approved limit, credit limit is given to every consumer, and we can very easily analyze here that SBI is offering overdraft up to 90% of the fixed deposit value of the consumers in their bank account. So in certain cases it may be possible that overdraft facility is given on the basis of some mortgage or some security where fixed deposits are needed to be deposited with the bank, and 90% of the value of the FD can be taken as an overdraft facility from the banking institution. So whenever there will be any overdraft facility that will be backed by any security, maximum to the extent of 90% you can withdraw from the bank. Now the next one is the interest and charges. Interest is charged only on the overdrawn amount by the consumer. That means on daily basis, whatever overdrawn amount will be there for a consumer, only on that particular amount the interest will be charged, not on the full limit. Suppose that if you have a limit of 5,000 and you have overdrawn only 2,000 rupees for a month, then on a daily basis monthly interest rate will be charged on an amount of only 2,000 rupees, not on the pre-approved limit of 5,000 rupees. So this means that you need to only pay the amount not only on the full limit but only on the amount withdrawn by you. And as per the Banking Regulation Act regulation and norms, not only the interest rate but certain processing fee and annual maintenance fee is also charged by the customer for the purpose of providing them a revolving credit facility of overdraft. Then purpose and utility. If we talk about the purpose and utility, mainly the corporate owners, the entrepreneurs, they take this kind of loan for handling temporary cash flow mismatches in their organization. So any kind of delays in the payment by the various counterparties related with the business, some unexpected expenses and losses, working capital needs, for fulfilling all these financial requirements, the overdraft facilities can be taken. Small and individual consumer, they may also take this kind of amount of loan from the bank for fulfilling their personal needs and wants in their life, and especially this may be useful for the small businesses for the purpose of managing their smooth day-to-day operations. So these are the key features of the overdraft facility. Now let us understand it more carefully with the help of an example. If we talk about how the overdraft facility can be taken by the bank, then suppose that if you have rupees 10,000 in your current account but you need to pay rupees 20,000 to any vendor for the purpose of purchasing any kind of raw material, equipment or tools. In such cases there may be an overdraft facility that may be offered by the bank to you of rupees 50,000. So your limit is 15,000. Then the bank will allow you to overdraw an excess of 10,000 rupees from your bank account. So you already have 10,000 and 15,000 is your limit. That means at a max you can withdraw 25,000 rupees at a particular point of time for fulfilling your financial need. So here in this case the consumer can withdraw rupees 20,000 rupees, and that will help him to repay the amount of 20,000 to the vendor for the purchase of a particular raw material or equipment or tool. So within an approved limit you can withdraw from the bank. That is the procedure of taking overdraft from the banking institution. Now let us understand what is the impact of overdraft on personal finance. If we talk about it, directly can affect your credit score if it is left unaddressed and reported to a collection agency. That means within the certified time period that is given by the bank to you for the repayment of such loan, if you do not repay the loan plus interest and the processing charge to the bank, in such cases it can affect negatively your credit score, as well as if it will be reported to the collection agency, your credit worthiness with the bank will also be negatively affected. as well as it has some long-term implications also, such as frequent overdraft can lead to financial challenges for the organization due to the accumulated fee, and it may signify your poor money management. That means if over a certain period of time you are not repaying your overdraft loan to the banking institution, the fee, the interest, whatever amount is left to be paid to the bank, it will accumulate, it will make financial stress and burden for you, and finally it will lead to the poor money management. So for managing your finances effectively, you should always try to prevent the overdraft in your organization. Now let us understand what are the different types of overdraft that a person can take from the bank. So basically there are 4 categories. Number 1 is the secured overdraft, second one is the unsecured overdraft, then there is authorized overdraft and unauthorized overdraft. So let us first understand the secured overdraft. What do we mean by the secured overdraft? As the name suggests, secured, that means this kind of loan is always backed by any collateral security, and the banking institution provides you the overdraft pre-approved limit on the basis of fixed deposit, property, or any kind of insurance policy or any other kind of financial asset that is provided by the consumer as a security to the banking companies. Since in such cases the bank holds the security against the overdraft, interest percentage, the percentage of interest that is charged by the bank is generally lower as compared to the other type of overdraft facility, and it is commonly used by the businesses or individual who want to leverage their existing asset for maintaining their temporarily liquidity situation. So simply we can take an example. Suppose that if you have an FD of rupees 2 lakh and you deposit it into the bank, you can get an overdraft limit of up to rupees 1,80,000, which may be the 80 to 90% value of your overall fixed deposit money. So in such cases the loan will be secured, and that is why the interest percentage will be lower as compared to the other types of overdraft. Now the second category is the unsecured overdraft. In case of unsecured overdraft, as the name suggests, it is not secured by any collateral security, and it offers the consumer loan on the basis of their credit worthiness, their credit records and history with the bank, and income stability, as well as banking relationship with the banking company. In such cases interest rates are normally higher as compared to the secured overdraft, because there is no collateral security against the loan, as well as it may be suitable for salaried employees or account holders who are having a strong credit history, as well as a regular and stable source of income with them. So bank can offer rupees 50,000 as an overdraft facility to a person who is having a salary of 1 lakh rupees per month in their bank account without any pledged asset against such kind of loan. So this is the unsecured overdraft. Now there is the another category, which is the authorized overdraft. Now in such case, as the authorized word is attached with this kind of overdraft facility, it is a pre-approved overdraft which is provided by the bank to the consumer. So this facility is formally arranged between the customer and the bank in advance. That means banks allows you to withdraw a certain limit on the basis of certain percentage of the interest rate, and repayment schedules are also discussed between the consumer and the banking company prior approving the loan of the customer in case of the authorized overdraft. So in such cases the customer can very easily avoid penalties, and they can manage their finances smoothly, as they have already negotiated with the bank about the pre-approved limit of the overdraft facility, the interest rate that will be charged, as well as the repayment schedule will also be discussed in advance before taking such kind of loan. For example, if a business agrees with its bank to have an overdraft facility of 5 lakh for working capital need, they will discuss it prior taking the loan with the banking company, that what will be the interest rate, how the repayment will be made, and what will be the pre-approved limit given by the bank to the business. So in such cases there will be a less penalty, as well as management of the business finance will also be easier for the business owner. Now the next category is the unauthorized overdraft. This kind of overdraft occurs when a customer withdraw more money as allowed by the banking company without any prior agreement with the bank, and they exceed the authorized overdraft limit given by the bank to the consumer. In such cases, it is considered as a breach of terms. That means the bank imposes heavy penalties, or they can also charge higher rate of interest for such breach of contract or terms by the side of the consumer in case of the unauthorized overdraft. So obviously such kind of unauthorized overdraft, if it is taken repeatedly by the consumer, then it can also deteriorate the consumer rating, as well as it can also impact the mismanagement of finance of the consumer may be there. So suppose that if there is a saving bank account holder or a current bank account holder in a bank, and they are having no overdraft facility, tries to withdraw 2000 rupees more despite having only 5000 rupees in their bank account, this case may become an unauthorized overdraft facility by the bank. So in such cases, heavy penalties are imposed on the bank for doing such kind of overdraft. Now let us understand how a consumer can prevent the bank overdraft, how they can minimize their overdraft facilities with the bank. So for this, we need to monitor our account balance regularly. We must be aware how much amount of money or balance we are having in our account, with the help of checking our account profile with the help of internet banking, ATM mini statement, or any other kind of inquiry can be made in the bank branches also, for the purpose of understanding how much account balance we are having. And this regular revision of the monitoring of the bank account will help you to understand how you need to spend in a particular period of time. Then you need to review your bank statement frequently. That means monthly bank statement must be taken by the consumer to track your spending habit and spot the unusual as well as the extravagancy expenses. So excessive withdrawals can be very easily avoided if you will have a check on your spending habits. So the expenses that can be avoided, that should be avoided with the help of reviewing the bank statements frequently. Then you can also make your bank to enable SMS and email alerts to you. They can activate the SMS or email alert facility that will help you to have instant notification after each transaction done by you with the bank, and it will help you to know about the updated balance with the bank account, and in such cases you can very easily avoid overspending by you. Next is using mobile banking apps. Most of the bank nowadays offer their apps with the help of which we can very easily inquire whether we are having a low balance in our organization in a bank account, and this can help us in real time check to avoid the overspending habit by the consumer. After that, we can also set up account limit or control. Some banks allows us to set up the transaction limit in our account. That can also help us in controlling our excessive withdrawal or spending habits. So this can help you to prevent overdraft, and this can increase your level of personal and business finance, and your business finance will be smoothly managed with the help of preventing the overdraft facility from the bank. So why we need to prevent the overdraft facility? Because it has certain impact on our credit score and the financial status, and that is why it should be avoided. A heavy percentage of interest is charged on the overdraft facility. For example, here you can see the Axis Bank is charging 14.95% to 19.20% per annum on the different types of consumers who are taking the overdraft facility from them. Bajaj Finserv is charging 9.75 to 30% per annum interest rate. HDFC is charging 10 to 22.50 per annum, whereas Kotak Mahindra is charging 16 to 26% per annum, and State Bank of India is charging 9.65% onward on the different varieties of consumers who are approaching to their branches for the purpose of taking the overdraft facilities. So, with this particular discussion, we can very easily understand that this excess payment of interest can be avoided with the help of preventing the overdraft by having a check on the regular statements of spending and balance of our account, and we can manage our finance well by avoiding the overdraft facility of the bank. Now, let us understand the next category of loan under this case. The next category is cash credit. Basically, cash credit is also similar like the overdraft facility. It is also a short term facility that is provided by the bank to the consumers. They may be businesses, the financial institutions and companies. They, for the purpose of meeting the working capital needs and short term financial need of the consumer, can advance such type of cash credit loan to their consumer. So, basically it allows the organization to withdraw funds even without a credit balance with the bank up to a predefined borrowed limit which is set by the bank. Such kind of cash credit is basically designed to finance the instant cash requirement of the businesses, such as for the purpose of purchasing current asset or managing the daily operations of the bank. Loan limits are basically varied in nature. Various commercial bank and other type of bank, they determine the loan limit on the basis of the credit worthiness of the consumer or the collateral that is provided against the loan to the bank by the consumer, as well as interest is also charged on the amount utilized only. That means not for the approved borrowing limit, only on the limit for which you have taken a cash credit from the bank, the amount of interest is charged and calculated on daily balance on the closing balance. So, typically it is restricted for a time period of 12 months or less. For this particular time zone, the consumer can ask for cash credit from the bank. The various key features of the cash credit are: it provides working capital support to the organization. So, for managing the day-to-day operation like purchasing raw material and paying salaries and wages of the laborers in the organization, you can take the help of the cash credit. It also has certain credit limit with the bank. The credit limit is decided on the basis of financial performance of the business and the collateral value that is provided to the banking companies from the consumer, that can help them to determine what kind of credit limit will be provided to the consumer. After that, interest is charged only on utilized amount. So, only on the amount withdrawn is taken for the purpose of calculating the interest that needs to be paid by the consumer, not the entire credit limit is taken for the purpose of calculation. This is also a revolving credit facility. That means you can withdraw and then you can repay your loan again. Whenever you are in need, you can withdraw from the bank. So, this goes on as the need of the funds arises in the business or in the individual's life, and the number of times of the withdrawal will also be always within the pre-approved limit of the cash credit. It is a secured facility. That means usually in case of cash credit, you need to provide certain mortgage or certain kind of securities such as the stock, inventory, receivable or fixed asset to the banking institution for the purpose of making it a secured loan. So, the borrowers must submit the stock statement regularly for the monitoring purpose to the banking institution to understand what amount of credit limit under the cash credit should be provided to the consumer depending on the collateral provided by them. The tenure and renewal of this particular cash credit is basically sanctioned for 12 months, and it can be renewed annually upon the review of the past financial performance of the business owner. So these are the different key features of the cash credit if we compare it with the overdraft facility. In case of overdraft facility, there are certain categories of the overdraft where you need not to provide any collateral security, whereas in case of cash credit, you always need to give certain asset as a collateral security to the bank. For example, suppose that if a company has a cash credit of 5 lakh, it withdraws 2 lakh to buy raw material and later it deposits 1 lakh after selling the finished good into the market. Interest is charged only on 2 lakh rupees for the time period for which it was used by the consumer. Now, the next type of loan that we are going to discuss that is given by the bank to the consumer is the mortgage. Mortgage is basically a kind of loan where for the purpose of purchasing or having a house or a property or a particular fixed asset, a consumer can approach the bank and they can ask for such kind of loan. So basically it is taken by the banking institution for purchasing or maintaining real estate such as any home or any land. In this arrangement, the borrower agrees to repay the lender, that is the banking institution, over a time through a series of regular payment the loan provided by them, and it covers both the principal and amount of interest that is charged on the loan sanction. So in such cases, why we are not calling it as house loan or any other kind of loan, because here in such case of mortgage loan, the land or the building or the real estate that is purchased by the consumer itself serves as a collateral security for the purpose of taking the loan. That means lender always has a right to seize the property in any case if the borrower fails to meet the repayment terms of the banking institution. That simply means that if you want to purchase a building, a house or a piece of land and you do not have sufficient funds with you, you can take the help of mortgage loan. You can keep the particular piece of asset as a mortgage security, as a collateral to the bank, and you can finance the purchase amount from the banking institution. This is the arrangement of mortgage. Now let us understand the key components or the key characteristic of the mortgage loan. In case of mortgage loan, principal amount is there. The original amount that is borrowed by the consumer is basically the purchase or acquisition cost of the property for which you are going to take the loan from the organization. Then interest, the cost of borrowing the principal, for that you need to pay an annual percentage of interest rate to the banking company. Term is basically longer, so it is a kind of long term loan for the time period of 15 to 30 years. Such kind of loans are taken, and the repayment schedules are made on the basis of regular payment. It may be monthly, made by the borrower, and usually on a monthly basis they cover both the amount of repayment, that is the principal, and the interest that needed to be repaid by the consumer to the bank. So these are the key components. Now the types of mortgages are fixed rate mortgages, adjustable rate mortgages, then interest only mortgages there, and government bank loans are there. The fixed rate mortgage has that particular type of financing facility where the interest rate for the whole period of loan will remain same. So every month your monthly payments will be equal and predictable. You need to pay a fixed percentage of interest throughout the time of loan repayment in case of the fixed mortgage. In case of the adjustable rate mortgage, the interest rate can change periodically on the basis of market conditions, and varying monthly payment may be there. So every time there may be charged some floating rate of interest, as well as the value of the mortgage may also appreciate. In such cases the interest may also decrease. So varied payment, monthly installment may need to be paid to the bank in case of adjustable rate mortgages. Then there are interest only mortgage. In such case, for a set period the borrower only pays the interest portion of the loan, and when the interest is paid, the whole amount of interest for a time period of 15 to 30 years is paid by the consumer to the bank. After that only the principal amount of the loan is repaid by the consumer to the banking company. That means they will first charge the interest as their payment schedule in their payment schedule, and after that principal amount will be taken. Then there is government backed loan. So this includes various types of programs of the government of India, such as FHA loan, VA loan and USDA loan, which is designed to assist a specific group of borrowers such as lower and middle income group of the citizens of the nation for providing them housing and other type of facilities. Now the process of mortgage involves these different kind of steps. First of all, pre-approval is taken by the bank. So you need to determine, for the purpose of determining how much amount the bank wants to finance, you need to first get a pre-approval by the banking agency so that they can understand how much amount they need to sanction to you as a loan. After that, house hunting is done. That means with the help of the pre-approval, borrower searches for a property within their budget so that they can purchase the house. Then the loan application is submitted to the bank and the property is selected, and after that necessary documentation is done by the banking company. Then processing and underwriting is done, where lender evaluates the borrower's financial status as well as the property's value for the purpose of assessing the risk that may be involved in providing the mortgage loan. And after that the loan is approved and loan is finalized, the funds are disbursed to the consumer. Then the borrower starts making the monthly repayment of the loan as agreed by the bank and the consumer. So this is the mortgage process. Now, what considerations will be there when we are choosing a mortgage? So obviously, as a consumer, you must compare the rates that are charged by the different lenders, different banks in the market, what interest rate they are charging, and most favorable terms and condition must be compared, that may be given by the different banks. Accordingly, the choice of financer, that is the lender of money, must be done by the consumer. Then loan term, you must decide for how much time period you need the loan. The duration of the loan must be decided, whether you need shorter terms, whereas in case of the shorter term you need to pay highly monthly payment, but if you take a longer term, lower monthly payment will be there, but total interest may be higher in such cases. So loan term must be decided. After that, fees and closing cost must be checked. What are the additional costs associated with the mortgage facility? That must also be determined by the consumer so as to understand what is the total cost of financing with the help of such arrangement. Then down payment, mostly a larger amount of payment, say 80 to 90% of the payment is done by the bank, but a down payment is required from the side of the consumer. That may be 10 to 20% of the total value of the property. So down payment can reduce the loan amount and it can potentially eliminate the need of private mortgage insurance also. So that must be also considered by the consumer before going for a mortgage loan. Now there is one more category of loan which is known as the reverse mortgage. We have understood the concept of mortgage, where for the purpose of purchasing a property we are taking the financial loan from the banking institution. Here in case of the reverse mortgage, for the purpose of taking loan, we will provide a mortgage of the property that we already have with us. So it is a financial product that is designed specifically for those individuals, such as senior citizens may be there, or any other individual who is not having a regular source of income but they are having a property or wealth with them, for the purpose of providing them a source of regular income streams and thereby enhancing their financial independence during the time period of retirement or during the time period for which they are not having a stable source of employment and income. That means in such cases the banking company, they provide you the facility where by taking your self-occupied residential property or any other kind of wealth as a mortgage, they will pay you the loan amount in an equal monthly payment. That means regular income streams will be provided to the consumer in the case of reverse mortgage with the help of the collateral security or mortgage that you already have. So unlike traditional mortgages where homeowners make payment to lender, here in the reverse mortgage the lender makes periodic payment to the homeowner for the purpose of financially assisting them in having a regular source of income. So in reverse mortgage, basically the borrowers first approaches to the bank and hypothecates the house to the bank, and once the bank evaluates the property, then the borrower receives monthly loan in installment from the loan duration. So first, second, third, fourth and fifth, for n number of years, for the total time duration, the bank provide the payment of loan to the consumer. Ownership of the house remains with the borrower. That house may be preoccupied or self-occupied by the owner himself, and the bank will provide them with the loan when the duration of the loan will complete or the borrower dies. In such case, the loan taken by the borrower is repaid by the legal heirs of the borrower, or the house is handed back to the legal heirs by the bank on the repayment of the total loan principal and interest as has been paid by the bank to the borrower. So it can be done by the legal heirs of the borrower, or the house can also be sold, and with the help of the sales revenue the loan can be repaid to the bank. So this is the proper arrangement of the reverse mortgage, where an elderly couple can have a regular and stable source of income without having a job or employment. So we have seen how it works. First of all, eligibility is there. You must be an age of 60 years or above for being eligible to take the reverse mortgage loan. In case joint applications are made, the younger spouse must be of at least 55 years of age for taking such kind of loan. The property must be self-occupied or free from any kind of charges from the other type of loan. So borrower's primary residence may be there in case of the property that you are giving as a mortgage to the banking institution. The loan amount is predetermined on the basis of the property's current market value. Suppose that if the property is of 1 crore rupees, then 80% of the property's appraised value can be given as loan. So in such case 80 lakh rupees will be sanctioned as loan, and the equal amount of the monthly payment will be made towards the borrower by the bank. So funds disbursement can be made as regular, monthly, quarterly or annual payment, or a lump sum amount depending on the agreement between the consumer and the banking institution. Interest is compounded on the total loan amount and added to the loan balance over the time period, and rates vary among the different types of lenders. So different bank charges different types of interest rate on the reverse mortgage loan. Repayment of the loan is made by the legal heirs of the borrower on the borrower's demise. If they are not capable of repaying the loan, then sale of the property is done, and the repayment is typically managed through the sale of property, and whatever surplus are there, that is returned to the legal heirs of the borrower. So this is how the reverse mortgage works. These are the benefits of the reverse mortgage: study income during the retirement age of the person. It helps you to continue to live in the same house for that you have given as a mortgage to the banking institution. No monthly repayments are required by the consumer to the banking institution. Here the bank will give you the payment until the loan period is there. Then it is a tax-free income. No tax is charged on the monthly regular payment that is made by the bank to the consumer. So it is not taxable because it is exempt under the Indian income tax laws of the country. And the legal heirs of the borrowers, they can retain the property by the repayment of the principal plus interest to the banking institution to keep the house. So these are the various types of loan that we have discussed today, that is the overdraft, cash credit and the mortgage and reverse mortgage. I hope with the help of all these discussion, you must be capable of understanding the various types of loan facilities that you can take for the purpose of managing your personal as well as business finance. Thank you.